The 2025 housing crash isn't a gloomy forecast anymore. It's unfolding in real time. Across the country, once booming markets are choking on inventory, blanketed by relentless price cuts and crowded with anxious sellers who can't carry the costs. In the most stretched neighborhoods, values are cracking fast, echoes of the darkest weeks of 2008, but with an even harsher backdrop of higher mortgage rates and steeper insurance bills. Builders are sounding alarms and dangling aggressive incentives. Buyers have stepped to the sidelines, waiting for clarity or deeper discounts. Investors who rode the boom are sprinting for the exits, trying to unload before comps drop further. From sun-bleached exurbs to calm coastal enclaves, nowhere feels fully insulated. Equity saved over years can evaporate in weeks. Monthly payments are squeezing household budgets, and the American dream is colliding with cold arithmetic. Today we're counting down 10 U.S. markets that aren't just wobbling, they're the epicenters of this decline. These are places where swollen inventory, longer days on market, and shrinking buyer pools are rewriting prices in real time. And the toughest truth? We're still early in the adjustment. Denver, the mile-high city, once symbolized prosperity, mountain views, a thriving tech hub, and an outdoor lifestyle that attracted remote workers and high-earning young professionals. Between 2020 and 2022, home prices skyrocketed more than 50%, pushing Denver into one of the most expensive inland markets in the entire U.S. But in 2025, the warning lights are flashing everywhere. With mortgage rates hovering near 7%, affordability has already collapsed for many families. Debt-to-income ratios are stretched thin, and households that once comfortably bought are now second-guessing every step. Inventory is up nearly 40% year over year, and the average days on market has stretched past 75 days compared to just a few weeks during the pandemic frenzy. The city's heavy dependence on tech jobs makes it particularly fragile. If hiring freezes or layoffs spread, demand could dry up almost overnight. That would force more owners to list, swelling supply just as buyer pools shrink further. Equity that residents built over years could be erased in a matter of months. In a true downturn scenario, Denver risks replaying the devastating 2008-style collapse, but this time under the weight of even higher borrowing costs. Now, from a high-altitude market under pressure, we move to California's capital, Sacramento, where the so-called Bay Area escape is unraveling. Sacramento, California's capital, was once branded as the affordable escape from Bay Area prices. During the pandemic, thousands of families fled San Francisco and Silicon Valley, driving a surge that pushed local prices up over 40% between 2020 and 2022. By the peak, the median home price sat near $540,000, and bidding wars became the norm. But in 2025, the story looks very different. That same median has already dropped to around $450,000, erasing nearly $90,000 in value for recent buyers. For a city where the median household income is only about $75,000, homes are now dangerously mismatched with what residents can realistically afford, especially at 7% mortgage rates. Monthly payments swallow such a large portion of income that many locals are forced to rent or simply wait it out. Inventory has jumped nearly 50% year over year, flooding the market with listings that sit longer and longer. Sellers are cutting aggressively, but buyers are thin. Investors who once treated Sacramento as a safe play are now retreating, pulling back capital and leaving more unsold homes behind. The parallels to 2008 are chilling. Back then, Sacramento was ground zero for one of the nation's hardest crashes. Combine that history with today's overvaluation and heavy reliance on external migration, and the city looks precariously positioned for another severe correction in 2025, one that could wipe out equity for thousands who bought near the top. Leaving California's capital, we head southeast to Florida, where Tampa's once booming market is fading faster than many expected. Tampa was once the poster child for Florida's growth story. During the early 2020s, the city exploded in popularity, attracting remote workers, retirees, and Wall Street-backed investors, all chasing sunshine and rapid returns. By 2022, the average home price climbed to around $383,000, with bidding wars so intense that many houses sold in less than 2 weeks, sometimes in just a few days. But in 2025, the market looks very different. Average home prices have already slipped to about $360,000, and the supply of available homes has surged more than 55% compared to last year. Properties that once disappeared in days now linger for 2 to 3 months, a clear sign that demand has cooled sharply. Another major pressure point is the short-term rental market. Thousands of Airbnb and VRBO hosts are rushing to sell, flooding the resale market with additional supply. On top of that, today's 7 to 7.5% mortgage rates have effectively priced out huge numbers of local buyers, leaving demand unable to keep up with the swelling inventory. The very forces that once fueled Tampa's rise, strong investor activity, rapid population growth, and easy credit, are now cutting the other way. Overvaluation and oversupply are the classic fingerprints of a bubble that has begun to burst. If these trends continue, Tampa faces the real risk of a significant correction in home values, with serious financial consequences for families and investors who bought at the peak. From Florida's Gulf Coast, let's move back west to California, where Bakersfield's affordability advantage has crumbled into a dangerous liability. Bakersfield has never been known for glamour, but it became a magnet during the pandemic housing rush. Families desperate to escape the sky-high costs of Los Angeles and the Bay Area poured in, chasing open space and lower prices. Between 2019 and 2022, the median home price here rocketed from roughly $240,000 to nearly $240,000, $440,000. An astonishing leap for a market once considered a budget-friendly refuge. But in 2025, the picture is far darker. The very affordability that made Bakersfield attractive has collapsed. With mortgage rates hovering around 7%, the typical payment on a median home now exceeds $3,200 per month, a level far beyond what most local families can manage. Wages in the region, tied heavily to agriculture and energy industries, have remained relatively flat, creating a dangerous mismatch between incomes and housing costs. Investors and flippers, who once accounted for 1 in every 4 purchases, are now dumping properties at steep discounts, often cutting $50,000 to $100,000 just to offload homes before prices fall further. Inventory is swelling, buyers are scarce, and the city is caught in a downward spiral where each new listing drives prices lower. If supply continues to rise while local wages remain stagnant, Bakersfield could see a catastrophic collapse of up to 60%, dragging values back to pre-2015 levels. For many families who bought at the peak, that would mean not just losing equity, but being trapped in homes worth far less than the mortgage owed. From a Central Valley market in freefall, we turn to North Texas, where Dallas's boom is starting to crack under its own weight. Dallas, the shining hub of North Texas, has long been a symbol of unstoppable growth. Fueled by corporate relocations, a booming tech sector, and relentless construction, the Metroplex became one of America's hottest real estate markets. Since 2020, home prices in many areas soared 60 to 80%, while developers blanketed the northern suburbs with new subdivisions, convinced demand would never run out. But in 2025, the cracks are impossible to ignore. Inventory has jumped about 45% year over year, and houses that once sold in days now linger on the market for over 75 days. Price cuts are spreading rapidly, and many sellers are chasing the market down as buyers wait on the sidelines. The risk is clear. If corporate expansions pause and relocation pipelines slow, Dallas could face a severe demand shock. With so many investors who piled in during the boom now looking for exits, the supply-demand balance could tilt violently, dragging prices lower across the metroplex. And because of Dallas's sheer size, a downturn here doesn't just affect neighborhoods, it reverberates through the entire North Texas economy. Mid-roll CTA. If these deep dives into America's housing markets help you plan smarter, take a second to hit that subscribe button for Nation Peak. Your support keeps us bringing you the data and insights that matter most. From a massive metro to a boutique desert town, let's head to Sedona, Arizona, where luxury buyers are suddenly vanishing. Sedona, with its breathtaking red rock formations and reputation as a spiritual and artistic retreat, became a magnet for wealthy retirees, second-home buyers, and investors looking for both beauty and profit. During the pandemic boom, median home prices soared to nearly $850,000, and luxury listings above the $1 million mark were snapped up almost as quickly as they appeared. But in 2025, the picture has shifted dramatically. Discretionary spending on luxury real estate has dried up, and Sedona's once insatiable demand is faltering. Inventory has surged more than 35% year over year, and many homes now sit for 100 days or longer on the market. Price cuts are not subtle. Multi-million-dollar properties are being slashed by hundreds of thousands just to attract hesitant buyers. Another growing burden is the soaring cost of ownership. From steep HOA fees in exclusive gated communities to rising insurance premiums tied to wildfire risks, the expenses of owning in Sedona have skyrocketed. High-net-worth buyers who once treated Sedona as a safe haven are now pausing or walking away entirely. Short-term rental investors are also retreating, finding that occupancy rates no longer justify the high purchase prices. What was once marketed as a tranquil desert escape is, in 2025, starting to look like a risky financial trap. Sedona's housing boom has clearly lost its momentum, and the city may face years of price correction before stability returns. From Arizona's red rocks to Nevada's neon lights, Las Vegas is showing us how quickly the gamble on real estate can go bad. Las Vegas has always been a city built on risk and reward, but this time, the house is losing. During the pandemic housing frenzy, Vegas became one of the hottest markets in the country. Between 2020 and 2022, the median home price shot up from around $290,000 to more than $460,000, a staggering 58% jump fueled by cheap credit, speculative buying, and a wave of out-of-state investors eager to cash in. Fast forward to 2025, and the tables have turned dramatically. The market is now in full retreat. Inventory has more than doubled over the past year, and homes that once sold in a single weekend now linger for 3 to 4 months. Nearly half of all listings carry aggressive price reductions, with cuts ranging from $50,000 to $150,000 depending on the neighborhood. The core problem is over-speculation. Investors who flooded Vegas during the boom are now dumping properties at a loss, creating a spiral of falling comps. Meanwhile, the short-term rental market, once a lucrative lifeline, has collapsed under soft demand, leaving Airbnb and VRBO owners desperate to sell. Add in mortgage rates holding stubbornly above 7%, and what was once a hot commodity has turned into a financial burden. Even more troubling, local wages never supported those skyrocketing prices. With a heavy reliance on tourism and entertainment jobs, industries still fragile since COVID, the city's housing market remains extremely vulnerable to broader economic slowdowns. If current conditions persist, analysts warn that Las Vegas could see values fall 50 to 60%, rolling back to pre-boom levels and wiping out billions in household equity. Leaving Nevada's casino capital, we head north to Boise, Idaho, where a pandemic Zoom town is learning just how hard gravity can hit. Boise was one of the most dramatic winners of the pandemic housing boom, and it's quickly becoming one of the sharpest losers. From 2019 to 2022, the median home price nearly doubled, jumping from about $285,000 to almost $575,000. This surge was driven by a flood of remote workers and investors who saw Boise as an affordable, up-and-coming Zoom town. But in 2025, the story has flipped. Inventory has exploded, and homes that once sparked fierce bidding wars now sit unsold for 140 to 150 days. The demand that fueled the boom has dried up, leaving sellers slashing prices to get attention. Investors, once confident they could ride the wave forever, are now panicking, offloading properties at fire sale discounts to avoid even bigger losses. At the same time, local families are being squeezed out. With mortgage rates still above 7%, the monthly cost of a median-priced Boise home now exceeds $3,800, a figure completely out of reach for most residents. Meanwhile, overbuilding on the outskirts has created half-empty subdivisions, with entire streets of unsold houses standing as a stark reminder of reckless growth. To make matters worse, foreclosures are creeping back up. For many in Boise, it feels like déjà vu from 2008, but with even greater risks, since prices rose so much faster this time. If trends continue, analysts warn Boise could suffer a 60% collapse in home values, sending prices back to pre-boom levels and leaving thousands of households underwater. From Idaho's struggling capital, we turn back to Florida, where Cape Coral's so-called affordable waterfront paradise is collapsing under the weight of insurance bills and empty homes. Cape Coral was once marketed as Florida's last great affordable waterfront paradise. During the pandemic boom, developers and buyers rushed in and the median home price doubled, from about $230,000 in 2020 to more than $470,000 by 2021-2022. New construction projects popped up everywhere, and buyers believed they were securing a piece of coastal heaven at a discount compared to Miami or Naples. But in 2025, Cape Coral is facing a severe reversal. Builders flooded the market with thousands of new homes, and now many of them sit empty. To attract hesitant buyers, developers are offering tens of thousands in discounts, covering closing costs, and even paying insurance premiums. But demand is still evaporating. A massive factor is the skyrocketing cost of ownership. Insurance premiums have more than doubled, with many homeowners paying over $9,000 per year due to extreme flood and hurricane risk. At the same time, property taxes are rising, and HOAs are demanding bigger reserves, creating an unbearable financial burden. Retirees who once flocked here are now rethinking their decisions, while investors are fleeing the market entirely. Inventory has tripled since 2022. And more than half of all listings have undergone deep price cuts. Days on market have doubled as sellers struggle to find buyers in a city drowning in supply. If these pressures persist, analysts warn that median prices could collapse back below $200,000, representing a 60% or greater loss in value. For many, what was once a dream home purchase now feels like a ticking financial time bomb. And now we arrive at number 1, Phoenix, Arizona, the city leading the 2025 housing crash, and a painful reminder of history repeating itself. Phoenix has become the undeniable ground zero of the 2025 housing collapse, eerily echoing its painful role during the 2008 crash, but with even more dangerous dynamics this time. Between 2019 and 2022, the median home price jumped from about $280,000 to nearly $280,000, $510,000, an 82% surge fueled by iBuyers, institutional landlords, and a flood of investors who scooped up properties, often sight unseen. Now, in 2025, the boom has turned into a bust. Inventory has quadrupled, creating an unprecedented glut of listings. More than 55% of homes on the market carry price reductions, many slashed by $100,000 or more. Houses that once disappeared in frenzied bidding wars now languish for 90 to 120 days. Even the big builders on the city's fringes, places like Buckeye, Queen Creek, and Maricopa, are offering record-breaking incentives, dragging comps down and accelerating the fall. The problem isn't just oversupply, it's affordability. With mortgage rates stubbornly above 7%, the monthly cost of a median Phoenix home now tops $3,800, far beyond what most local households can pay. Average incomes simply haven't kept pace. At the same time, rents are softening, leaving investors stuck with properties that no longer cash flow. Some are resorting to fire sale exits just to stop the bleeding. Even more troubling, foreclosures are climbing again, especially among buyers who stretched finances with low down payments or FHA loans. The cracks are widening into systemic risks, suggesting Phoenix could suffer a 60% collapse in values, wiping out trillions in household wealth and shaking the broader regional economy. Phoenix isn't just falling, it's leading the crash, showing the nation what happens when runaway speculation collides with harsh economic reality. So what does all this mean for buyers, sellers, and investors watching from the sidelines? The verdict is clear. The 2025 housing crash is no longer a prediction. It's here, happening in real time. From Denver's overstretched tech hub to Phoenix's overbuilt suburbs, cities that soared on easy credit, investor hype, and pandemic migration are now collapsing under the weight of high rates, bloated inventories, and affordability that simply doesn't exist. Across America, equity is vanishing overnight. Mortgage payments that once felt manageable are now suffocating families. Builders are slashing prices and throwing in incentives. Investors are scrambling for the exits, and everyday homeowners are waking up to find their neighborhoods flooded with for sale signs. The dream of homeownership hasn't disappeared, but it's been distorted, turning into a financial nightmare for those who bought at the peak. So what should you do? If you're a potential buyer, be patient, cautious, and brutally realistic. Run the math at today's interest rates, not yesterday's. Factor in insurance, HOA fees, and hidden costs. Sometimes the smartest financial move is not rushing into a deal, but waiting for the market to settle. And if you're a seller, understand that today's market belongs to the buyer. Pricing aggressively is the only way to move property before values sink further. This is the kind of insight that can save you tens of thousands of dollars and years of financial stress. That's why we dig deep into the numbers and trends here at Nation Peak, to cut through the noise and give you a real look at America's housing market. If you found this breakdown valuable, hit that like button, share it with friends or family who need to hear the truth, and most importantly, subscribe so you don't miss our next deep dive. Because sometimes the best investment decision isn't about choosing where to buy. It's about knowing exactly where not to buy. This has been Nation Peak. Stay informed, stay cautious, and we'll see you in the next video.